Hi, everyone. Welcome to this live moment. Let's call it that way. I'm here to share with you my views from the technical, fundamental perspective for the rest of the week. So I will start by, as usual, by taking a look at the macroeconomic calendar. There's plenty going on around the world today. We're having a weaker dollar because it's ahead of a release of US inflation data coming in a couple of hours. All right, and the market being a bit cautious after buying the greenback last week. But I want to make a point on a particular currency, which is the pound. All the Brexit woes and talking about being a hard Brexit or not have, of course, affected the pair, and we have seen the pound dollar trading close to 120 last week. Uh, Leaving aside the wild spike we had a few days before, uh, the fact is that there's some relief given that Prime Minister Theresa May has said that he will let the parliament vote over her decision as long as they don't revert it, right? But the fact is that there's a lot of another political votes going on around the Brexit. One of the is, and despite later deny it, that there are divergences between cabinet members in the UK about how to handle Brexit. The other thing that seems quite relevant, right, is that Scotland, sorry, is planning to call for a second referendum because no matter what the UK does, they want to stay in the UK single market, right? In the euro area single market, sorry. But what I believe that is even more relevant is what Angela Merkel from Germany said over the weekend, that if the UK is to leave the Euro Union, then they won't be getting the benefits. And it pretty much makes sense, right? Because this is like a society or marriage. You can get benefits without the compromise, right? Meaning the UK wants to live it, but keep on the benefits of being within the euro area. So I don't. There's no way we are having something else than a hard Brexit, right? And in the end, it will be terrible for the UK economy, at least for a couple of years. Maybe they will find out a way to settle after that, but news are not going to be any helpful for the pound. So I still believe that any pound up recovery we see these days, or the upcoming days, or the upcoming weeks, uh, will probably be a good opportunity to sell. So I would like to find long, strong resistance, right? And try to sell against them, particularly if we have this kind of moments like this one where the greenback is going lower. Of course, we are not sure how inflation will come, but if the year's upcoming inflation is better than expected, we will probably see the dollar resuming its advance, right? And the other thing that I want to mention is that latest dollar strength is partially based on, of course, speculation that the Fed will raise rates on December, right? Despite Yellen mildly dovish comments in our last Friday speech, the fact that Hillary Clinton is taking lead in the U.S. elections, regardless of political stance, the fact is that Clinton is seen as more stable, while Donald Trump is seen as a wild card, and that he will probably be a pain in the lower back to the financial markets. So that's bringing some relief also to the markets. But I do believe that also we are having a lot of euro and pound weakness, and that is probably one of the main reasons why the dollar is higher. Okay. Anyway, moving into the calendar for what we had and what we could expect, the fact is that September inflation in Europe came in final readings, okay, for September came in line with previous estimates and in line with market expectations. Really no shock in here. Still far, far away from the 2% target. This is relevant because we have the ECB meeting on Thursday, right? And Mario Draghi will have to defend these figures, and his ongoing stimulus program, right? I don't believe he could handle much. I'm not really expecting him to make an announcement. He will probably repeat that they are in the implementation stage, right? So no much action and probably disappointed for Forex traders. Anyway, inflation in Europe, it's doing bad. What it's also doing bad is the US manufacturing sector. Not as bad probably as European inflation, but bad anyway because we had this New York Empire State Manufacturing Index falling well below market expectations and previous. And during the past week, we had the same going on in Chicago with the Chicago index. And although they are not those kind of headlines that actually move the market, they are indicating us that the manufacturing sector in the US is still struggling, to grow steadily, firmly, right? To convince us that the US economy is in motion, right? The same happened with the industrial production and capacity of utilization released this Monday. So far today, we have inflation in the UK, which of course it was it was better than expected, right? Output, PPI output and inflation, consumer price index rose above expected, which is not a big surprise. Everyone was expecting that with latest Bank of England easing and a cheaper pound that is fueling consumption in UK. The fact is that how healthy this inflation it is and how healthy it will remain if it keep on rising is something yet to be seen, right, guys? These are not really so great news, but anyway, are helping the pound to rally today. As I said, EIs today are in this consumer price index in the US. Honestly, not much in a year monthly basis, 0.3%. The main reading 0.2. The core really depressing. We need a bit more than this, right? But at least this one seems a bit more interesting. It would jump from 1.1 to 1.5 yearly basis. This needs to get closer to 2.0%, right? This is the one that needs to be there. And with the core inflation up to 2.3, the one that filters food and energy prices, if we had the 2.3 or 2.4, then the other readings above expected, that will be good news for the greenback, okay? On Wednesday, I do believe that this kind of massive Chinese releases, which are due of the latest holidays in the country, will probably set the tone. We had poor trade balance figures in China last week, and a couple of days later, we have great inflation numbers. Not great, but better than expected numbers. And both releases were enough to trigger strong moves in Asia that extended into Europe and the US, right? China sets market sentiment and will probably continue to do so. So take a look beware of these releases on early Wednesday. Sorry, because they will probably set the tone for the rest of the day, okay? In the UK, employment figures, of course, will be the most important reading is of the session, and later in the US, housing starts and building permits. I believe that we discussed this lately. The housing sector has started to ease in the US. We have had some disappointing figures lately. So, and of course, a bad number in here, it's pushing the greenback lower. So, beware of them, okay? Beware of what happens in here. I do believe that a good number will following today, if we have today a good inflation reading, will build up the case for a December hike. Whether we as individuals believe in it or not, it's not what we believe, it's what the market believes. So watch those reports. Also on Wednesday, the Bank of Canada would take its economic policy decision. No changes are expected in the year, so the statement would take the attention, and of course, dovish, hawkish will be good or bad for the Canadian dollar, but not really expecting this to affect much the rest of the market, okay? On Thursday, Australian employment will probably set the tone for Asia, while UK retail sales, these are relevant, or probably will beat expectations. Okay, will probably keep surprise to the upside considering what we saw today in inflation, right? But the market may wait for the ECB and whatever they have to say, whatever Draghi has to say on the economic policy. Okay. Anyway, another housing reading in the US that can help or sunk the greenback, and a quiet Friday with not much in the way except probably consumer confidence in Europe. Okay. Anyway, let me change a bit. Let me change. Okay, to charts, which are always so much more interesting. Oops, sorry, give me a second. Okay, here we are. The first thing I can mention today, or what I can see when I see the full market, right? It's that neither the euro, neither the yen are deriving momentum against the greenback, despite the rest of the market seems to be happily selling the dollar, and even we are having gold gaining ground today, right? The Aussies and CAD are probably the best performers. Uh, today, but the pound is also in recovery mode, but the euro is refusing to stay above 110. The Japanese yen is struggling with 104. I do believe these two are $2 dependent, guys. And there's little that news from this both economists can do for these currencies, but we were I'm sorry, I lost the grip of my idea. What I'm trying to say is that these currencies will probably depend always much more on whatever the dollar has to say than whatever the euro or the yen or self-data or self-strength or weakness can do. Sorry, that dog, it's distracting me like hell. And it's a neighbor's dog. I would kill my neighbor, would kill the dog also. Anyway, sorry for that. Let's take a technical look at the euro, okay? The pair has been stuck in this range for almost 2 months, or a bit more than a month and a half, whatever. The fact is that what I have seen in the daily chart is that back then, of course, moving average were directional, right, and going horizontal, and slowly we are taking some direction here, although what I'm seeing is that this 200 and the 100, which is just the blue, are still not gaining much directional momentum, but at least they're moving lower. And the shorter one, of course, is the one that's moving faster, following price and breaking below the largest. But the picture coming from here is still not enough to confirm a longer term downward move, but at least it's putting the risk toward the downside, right? Furthermore, what we are seeing these days is the pair has fell, and so far the rally has been contained by this Fibonacci retracement back here, right? When we had the slow, the rally still below the 30, at that point, the 38.2%. So overall, I do believe that this upcoming moves are corrective, and in fact, unless the pair can settle and close the day above this 1050, 1060 region, the risk will probably remain to the downside. Okay. In the forward charts, we also had, let me put it smaller, right? We also had that moving average congestion, right? Showing us no certain directional strength, but of course that finally ended last week. And here we are with the 30 moving average moving alongside with price struggling to get above it, but not even getting the chance, and the 1 and 200 ones moving lower. What I'm seeing also here, what I pay attention to usually, is the fact that the 101 it's moving, detaching, let's say, farther below the 200, right? They are moving both below. They are moving both towards the downside, sorry, but of course, it's moving faster, which is an indication of the market's bearish sentiment, right? And what I have also observed in these charts is the fact that indicators have corrected higher, but were unable to regain their midline. So even since the break lower, right? So, and the risk for me remains toward the downside. What I'm thinking of is that this low is not for me the immediate support, but this one, which is July monthly lows, 950, 951. So this is for me the immediate bearish target in the case of a dollar rally. If we break above it, the pair can go to 910, which is the post-Brexit low, okay? If somehow the rally declines below 900, then 840 region is my next bearish target for this week, okay? 840 for me, it's sort of line in the sand, a critical support region, uh, and although there could be some spikes below the level, the fact is that we would probably see the pair bouncing back from there. And I'm not waiting a breakup below that level at this point. Probably uh, with the US rate hikes, but not before. Anyway, the immediate resistance for me is the 1020, 1030 region. We have heights, lows, and this Fibonacci area, the 1055, 50, 60 region we mentioned yet earlier. And of course, 111, 111.20. It's probably tops for this week in the case of further dollar slides. Okay. When it comes to the pound, the fact is that today's recovery seems quite modest. Okay, the pair has managed to extend briefly above that 23 region, but it quickly came back. Uh, I'm not really seeing much of an upward corrective movement, and the fact that we remain below the highest, this is 40, 24, sorry, 80, the highest post that while plumped early October, all right, maintains the risk towards downside. I believe that this is sort of a line in the sand, right? The immediate resistance, however, is this 23.30 price zone, which is October 12 highs. We need to gain that level to see a bit of more of an upward potential up to 24 and the 24.80 region, right? We were talking. So not seeing much of a bullish case. And what I'm also seeing is that indicators have managed to correct extreme readings without the price moving that much higher. So that is usually telling us um, that the price will probably resume its slide, right? The bearish trend here is strong technically and fundamentally. In the daily, I was saying that the RSI, sorry, was still in extreme oversold territory. So no much to do about this. It's extremely oversold, but the fact that it's below 30 and that there's no upward strength in here is telling me that there's no upcoming huge corrective movement underway, okay? I'm not sure if I mentioned supports, but 22, 20 to 10 is the immediate one. If we lost that level, 21, 40, 30. 21, 30, 40, sorry, it's the next one, followed by 2090, 2080 price zone, which is the lows we had on October 11, right? Sorry. For the dollar Japanese yen, there's really not much to say, but the fact that the pair remains above 104 or around it, it's telling us that the strong buying interest thing around the Japanese yen has its. Overall, I do expect the upward the pair to consolidate and even run higher. Remember, we discussed that it broke above the 100 simple moving average for the first time in I don't know how long, a lot of time. I didn't check before getting in here today, but the fact is that we are above that level. The moving average is today around 100 to 50, 60. So I would say that as long as the price remains above it, the downside will remain the longer outlook. Okay. Anyway, I'm back to the chart this term. The fact is that the pair has tried to move beyond 100 for 40, 60, but couldn't. We are still far away from having a clear upward momentum in the forward charts. Slightly positive tone is here. Higher lows, right? Higher highs. The 100 crossing above 200, but indicators telling me nothing around their midnight. So I would like to see some really strong dollar momentum following a quite encouraging figure, right? And the pair breaking above what is 104.60, moving up to 105, 105.10. But above that level, we can go up to here, 106.60, right? And the 38.2% retracement, sorry, of the huge yearly rally between 2011 and 2015, right? Those are the levels I'm looking for. And as it said, moves down to towards 160 will be taken by the market as buying opportunities. Um, this lows around 103.20 are for me the first support ahead of that daily moving average. Okay, those are the levels I will be watching in here. And on the OC, sorry, uh, I have draw this trend line in the daily charts. Probably not the most beautiful of the moving averages. The trend line, sorry, it's probably not the most reliable. We have some consolidation in here, right? But the test of the trend line has trigger bounce, and we have last week a brief break below it, but the pair quickly recovery and even recovered the 76 level. So overall, I would say that the range will persist. I do believe that we discussed this plenty of times. 74.50 is for me sort of the line in the sand. As long as above this level there, I'm not seeing a real risk towards downside in the OC. Um, but 77 seems to be the roof, right? Spikes above that 77 level have made selling interest. The pair has been unable to just hold above it. So maybe around here it's a bit late to buy, right? But if we have a spike above 77, we can try selling against this high, which is 77.60 or so, right? That's what I'm thinking about this particular one. And finally, about gold, the fact is that today's recovery, it's really modest, and it's inside. The price is still inside within last week range. What is more relevant for me is that after breaking below 1300, right, the price also broke below this huge Fibonacci resistance now, right? That time was a support, now it's a resistance. 1266.30, right? It's the correct level. It's the rally between May and July this year, and so far we have remained below it, right? So unless we see some steady recovery above that level, I will go short with gold, right? I always said 1150, that's close to production cost, so those levels were probably held. I'm not seeing gold going anywhere lower than that, and if we get closer to that level will be buying opportunity. And I honestly don't believe we will get there unless, of course, I don't know, GLN comes out tomorrow saying, hey, we're going to raise the rates today or something like that, right? And anyway, it can happen. Anyway, that 1266 is for me the immediate resistance, but overall the stance is bearish. Indicators are barely correcting from oversold readings in the daily charts, but the 20 simple moving average has broken, sorry, below the 1 and 200 moving average, right? That's strong indication of a bearish momentum. It has been a bullish momentum back in earlier this year, so this is the first sign that the bears are in control and will probably continue there, right? The immediate support for me is this area around 50.51, where I have plenty of flows, and this one around 41 is the next one. If we lost at 1200, seems more than likely for the upcoming days. Okay, anyway, I spoke too much today. My time is done, so thank you so much, guys, for being here. Okay, thank you, and see you soon. Okay, I told you we are going to cover Live the SDB with Mauricio and Yohai, so see you then. Okay, next Thursday. Thank you, and bye bye.